Hey, good morning. Ralph Mendez here. We're going to work on chapter 8, homework. All right, so stop share. We'll just make sure we have it here. All right, very good. So long-term assets are those that are going to stay in the business and used in the business longer than 1 year. Current assets are 12 months or less. So here you pay $400,000 for real estate with land improvements, and building. Well, you have to allocate the cost. They were appraised. The land was appraised for 176, and the improvements are 66, and the building is appraised for 198. So you have to figure out. So the total value appraisal is 440. So what percentage is 146 of 440? 66 of 440, 198 of 440. So do your math. 176 divided by 440. So that's 40%. 66 divided by 440 is 15. So this will have to be 45 to add up to 100. Now, what did you actually pay? You paid 400 to 140. So multiply those percentages by what you paid to get how you're going to allocate the cost. It was appraised for 440, but you only paid 400,000. So you paid about 40,000 less. So you got to multiply by those percentages. $160,056. 15% of that number. And let's see, and they all have to add up to that. They all have to add up 180,063. Now in this case, they add up. The 400,000 matches that 400,000, so we should be okay. We've allocated them right. All right, let's go on the second one. Oh, they want the journal entry. Record the journal entry, record the purchase. So you're going to put land improvements, and building. So what did you buy? Assets, land improvements, and you bought a building. And how much did you pay? Cash. Let's assume cash. How much? 400 to 140, right? So that's what they paid. Okay. 400, 140, and you have to use these amounts. 160,056, 60,000, and the 180. And they'll add up to that. All right, let's go on to number 2. Straight line depreciation. Straight line depreciation. Well, you have to figure out the formula. But let's first make sure y'all know that this is used in real life. These are useful things. These are real things we're learning. Well, right here. Here is Walmart. So I'm on Walmart page, your annual report. I'm at the top of page 60. So just so you can trust me, Walmart, Inc. And this report is just from a few months ago here. Okay. So let's see where it was. 59. Here we go. 60. Here's what it paid for its land, buildings, and furniture. What the problem, like you just did. And what's its estimated life? Right here, 3 to 40, 1 to 30, 3 to 15. And look what it does. Property and equipment are recorded at cost. Costs of major improvements are capitalized. Costs of normal repairs and maintenance are expense, like we talked, is incurred. And the following table summarizes the company's property and equipment and includes estimated useful lives that are generally used to depreciate the assets on what? What's the basis? Straight line. So that's what you're doing here. So cost minus salvage divided by the useful life in years. You can use others. Now it's an estimate. It's not a real number. These are estimates. And you're allowed to use estimates. You're allowed to use estimates in business. The consolidated financial statement prepared in conformity with U.S. generally accepted accounting principles, GAAP, GAAP, These principles require managers to make estimates and assumptions. So we don't know for sure how long it's going to last, but that's that's the way it works. You're allowed to use estimates and assumptions. All right. So now cost minus salvage divided by estimable useful life will give you the depreciation expense. They pay 69,000 and they're going to use it for 200 concerts. After 4 years, you can sell the equipment. So the salvage is 1,000. Cost minus the salvage looks like it's going to be 68.2 and perform 200 concerts. So let's use, what did I give us here? Are they allowed to use 4? So the depreciation expense, let's see what it is. 68.2 divided by 4, 17,050. Let's just check our work. You're gonna let us do that? There you go. Cost minus salvage divided by useful life. Now, the Matthews Band plays 66 for sound equipment. It'll use the equipment for 4 years to perform 200 concerts. You can sell the equipment for 1,000, so there's the salvage. During the first year, the band performs 40. Oh, it wants to use units of production. So instead of the estimation being on life of years, it's going to be based on the production. And the production is, what's it, 200 concerts. So select the formula for depreciation. Cost minus salvage divided by, instead of being years, it's by this, units of production. So take that amount, 66 minus 1, cost minus salvage divided by the 200 concerts. So 65,000 divided by 200 concerts is going to be $325. They think it goes down in value every time. How many concerts did it do? 45. So you're going to multiply that 45 times 45 to get your depreciation, and it's 14,625. So depreciation per concert, concerts in first year. Now I tried to find on Exxon, they use units of production, but I couldn't find it in the notes. They explained something else, but right here is property, plant, equipment, and they talk about depreciation, depletion, but they don't tell us the method here. I couldn't find it because they talked about a lot of things here that they're going to, under the plan is approved, the corporation no longer plans to develop a significant portion of its dry gas portfolio, including a portion of its resources, the Appalachian, Rocky Mountains, Oklahoma, Texas, Louisiana, Arkansas. But it doesn't talk about exactly, I'd like to be, I wanted to be expanded. Does it give me the things here? It doesn't tell me the method, but I know they use units of production. It just doesn't mention here that they use both straight line. It just doesn't tell us. It doesn't tell us. All right. Well, we'll go back. Anyway, that's how you do units of production. Double declining. Now, double declining is beginning of period book value. And the book value is what you pay. The depreciation rate. If the useful life is 8 years, double declining balance means twice the straight line. So straight line gives 1/8 per year. So double declining would be 2 times 1/8 or 2/8. Now, if something lasts 4 years, the straight line rate would be 1/4. Double declining balance means you get 2/4. Straight line rate for 5-year property would be 1/5. Double declining balance means you get 2/5. If it was 10 years, you get 1/10 per year straight line. Double declining balance gets 2/10. But it's a little more complicated. So now we've got to go through an example. So in this case, it's going to be 2/8. Does it give us that option? So 1/8 and then a 2 divided by 8 is 0.25. Depreciation rate, 25. So depreciating expense is 25% times that 910. You notice you did not use the salvage. You did not use the salvage. So The accumulated depreciation, remember the journal entry, depreciated expense is debited, accumulated is credited. In the book value is what you paid minus what you've recovered. What you've paid minus what you've recovered. So the big book value is 682.5. Now the second year, you have to start off with the book value. And the book value is what you paid the first year minus what you've recovered through depreciation. And you have to put in the 682,500 here. And it's still a 25% rate. So 682.5 times the 0.25 is 170, 625. So it added this plus this, 227 plus that. So you've recovered 398 after 2 years. And the book value is 682 minus this depreciation expense. Now you're down to 511. So the third year, what's the book value? What's your rate? Now, it's 1/8. It goes 8 years, and we're only doing 3. The difference in this method, it will subtract. The salvage is this 81,900. You'll use the salvage. You'll subtract that in the last year. It's different than the other method, straight line. Remember, straight line was cost minus salvage. In this one, the salvage is not subtracted till the last year. All right, do they like what we did? All right, we'll go on. Double climbing balance. Install new machinery, cost 49,000, useful life at 10 years. So what's the factor? Twice the 1/10. It's twice that, or 400,000 units with a salvage of 9 during its second year to produce this. To determine the machine's second year depreciation, you double climbing balance. So when did it buy it? Installs a computerized machinery at the beginning of the year to cost of 49. First year. So here the factor is beginning book value times twice the straight line rate. In the first year, you're going to pay double declining balance. 1/10 times 2 is 2/10, and 2/10 is the same as 20%. Now the second year, you have to take 49 minus the 98 times the 20%. So remember, it does not use this salvage of 9,000 like the straight line. It just whatever you paid times 2 times the straight line rate. 1/10 times 2 is 2/10 equals this. And that's also the accumulated depreciation after year 1. Depreciation expense accumulated. Well, to get the book value, you have to take what you paid minus what you've recovered is 39. And if you were doing the third year, it'd be this 39 minus the second year. So the third year, you begin on about 32. All right, let's go on. Number 6, straight line. Remember, what's the formula? Straight line. What's the formula? Beginning book value? No, that's double decline balance. Cost? No, it's cost minus salvage. So in this method, and then you have useful life. Is it in years or units of production? Well, what does it want us to use? It's a computer equipment. So that's usually for 4 years. That's a lifetime. And the salvage is 28. So in our case, it'd be 260 minus the 232. And how did I get that? 260 minus 28. And useful life is 4, right? Oh, it wants to know the year-end book value. So it's 232 is what we depreciate. Divided by 4 is 58. Now let's make sure everybody understands 58 every year, 58 every year, 58 every year, right? And that has to add up. The 4 years add up to 232, which is 260 minus the salvage. What's the book value? What's the book value at the end of year 1? 260 minus the 58 is 202. And then the next year, what's the book value? 202 minus the 58 is 144. And what is about year 3 minus 58 is 86. And 86 minus the 58 is 28. Oh, look, the book value ends up at the 28. You cannot go below the salvage value at the end. So annual depreciating expense is 58. They don't give it here. What do we put here? Choose the numerator. Choose the numerator. Cost minus salvage. So in our case, it's 232. Useful life 4. I guess I didn't see this. I'm going to put 4. All right. No, 2. I'm sorry, 232. There's how to get to 58. No, what did I do here? Try to talk to y'all and forgot all my zeros, huh? Well, remember, I'm trying to talk and calculate and enter data all at the same time. All right, let's go on to the next one. Straight line. Double declining balance. All right. Did Tex purchase a computer at 260? Do you subtract the salvage? No, not until the last year. And just to prove this to you, that's why we have to do this one. 260. How many years does this thing last? 4 years. So what's 2 times 1/4? 2 times 1/4 is 50%. What's the annual depreciation? 50% of that is 130. And accumulated is 130 because the first year it's depreciation spent 130, accumulated 130. What's the book value? Beginning, what you paid, minus your accumulated. So at the end of the year, it's 130. So that's also the beginning of your next year. 130. How much do you get a year? 50%. What's 50%? 65,000. What's the accumulated? 130 plus the 65 is 185. So far you paid 260 and you've recovered 185. So what's the book value? So it'd be 260 minus the 185 is 75 left. And oops, gotta add my zeros. 75, 75, 50%, 37.5. What's my accumulated? 185 plus 37.5. 185 plus 37.5. 222.5. Let's see. 222.5. 222. 222,500. Now what's the book value? 260 minus 222,500. The book value is 37.5. In the last year, no, you don't use the percentage in the last year. You have to subtract the 28. This is where you use the 28. You got to subtract 28. So you just take 37.5 minus the 28. So in the last year, you only get 9,500. Now, well, let me get rid of that. See, it won't let me delete that, and I wish it wouldn't be there. Now, the accumulated is the 232. And I hope you realize that that's in the year-end book value should be the 28. Now, let's check my math. 260 minus what we recovered over the 4 years, 232, should equal my salvage, and it's 28. But in the last year, that 50, it shouldn't be there. I wish I could get rid of that 50 right there. The last year, year 4, 37 minus 28 is you only get 95. Now, look how much you get. Now, why did it add up to 242? It should only add up to 260 minus 28. It should only add up to 232. So let me do that again. 130, 37.5, 222 plus that is 232. 260 minus 28 So this is right, 232, but why did this add up to 240 depreciation? It should be 28. All right, let me see what I did wrong, if I did something wrong. 30, oh, my math was bad. 165 and 130 is 195. See, I made a mistake there, and the mistake carried on through. Okay, 160 here is 195. And then over here, 260 minus the 195 is 65. And then this should have been 65. And then this would be 32.5. And then this 32.5 plus the 195 is 227.5. And this is 32.5. 32.5 minus the 28. So the last year should only be 4,500. And then this 227 plus 232, and this should be 28. And now they match. You see, they should have matched before. Okay, let's check now. I should have it right now. Oh, see, didn't bring me a zero. Okay, y'all know what I did wrong there. Let's go on. All right, straight line for the last 3 years, straight line for the second year. Now this one, what happens is you're doing straight line for a wind turbine, 290, and expect it to last 6 years and have a salvage of 35. So how much is that per year? 290 minus the 35 salvage divided by the 6 years. You're supposed to be getting 42.5 a year, 42.5 a year. And then, but the thing is, you didn't buy it till October, November, December, October, November, December. How many 12ths is that? How many fractions of the year is that? 3 12ths. So 42.5 times 3 divided by 12 is 10,625 the first year. And then straight line for the second year, which was so 42.5. All right, so they're just showing you bought it, you only get 3 months in that. Let's check my work. This is 3 12ths of a year, and this is all 12 12ths, which is 1. All right, now they want you to do partial years. Purchase a trencher for 320, expected to last 5 years, have a salvage of 60. They use straight line. And here's the thing, though, they bought it on April. So how many months is April? How many 12ths is that? January, February, March, or 3, January, February, March, you didn't buy it then, so it's 9 12ths left. So, you know, it's going to be cost minus salvage divided by useful life in years equals annual depreciation. Put in the numbers, and then do the fraction of the year. What's the fraction of the year it is? Well, it's 9 12ths for that one. And the second year is going to be 12 12ths, right? All right, so, okay, 5 years of salvage. All right, so remember, 320 minus 60, 320 minus 60 divided by the 5 years, give you your annual. That annual goes right here. There you go. All right, let's keep going. Let's see what this one is. Double declining partial year. All right, so beginning of the period book value. What's the beginning? 320,000. Depreciation rate. What's the difference? It's 5 years. So what's 1/5 times 2? What is 2/5? That's 40%. Is it a partial year? Yeah, they buy it on April. What's the partial year? Is that 3 12ths? No, it's 9 12ths of the year. So there you go. That's how you get the depreciated. 320 times 0.4 times 9 12ths of the year. That'll give you your depreciation expense accumulated. And this cost minus your accumulated gives you your book value, and your book value is what you start off year 2 with. Computing revised. So this is where we got to take a see here. This is a little bit, now you're revising the depreciation up or down. And we just finished reading that Exxon does that right here. It says The decision not to develop the assets resulted in non-cash before tax charges of $24 billion in upstream to reduce the carrying value of those assets to the fair value. So right here, we see this. These things are real. We're learning right now in this class. Right here, under the plan is approved, the corporation plans to develop a significant portion of its assets in resource Appalachian, Rocky Mountains, Oklahoma, Texas, Louisiana, Arkansas, as well as U.S. Western Canada. But then what happens? Because you decide not to develop, we have to put non-cash, which is depreciation accumulated, before tax charges of 24 to reduce the carrying value of those assets. So they're reducing the value of those assets due to the impairment not going to produce. Now, in this case, the Matthews pays 67 for sound equipment. It's going to last for 5 years, and after 5, it can sell for 2. So right away, 67 minus 2 is equal to 65 divided by 5. They thought they were going to depreciate $13,000 a year for 5 years. Matthews used a straight line, but realized at the start of the second year, the equipment's only going to last 3 years. It's not going to last 5 years. So the book value at the end of 1 year, so 67 minus 2 is 65 divided by 5 is 13 per year. And at the end of 1 year, you've used 13. So 67 minus the 13, the book value is 54. And how many years are left? They're only going to last a total of 3 years. Well, we used 1, so that means there's only 2 left. So the next depreciation is 54 minus the 2 divided by 2. I'm going to say it's only 26. Let's see what they say. 26 remaining depreciable cost. Oh, I'm sorry. I thought it wanted years there. All right, so return to the question. So the book value is 54. Remaining depreciable value is 52. There you go. How about now? Okay, very good. 54 minus the salvage of 2. So, all right, so it was supposed to last 5, and it's only going to last 3. So you got to take it down, revise it downward. Revenue and capital. You know, you did this on the quizzes, but essentially it's asking you to classify. Paid 60 to replace a motor and equipment extends its useful life beyond 1 year. So that's not an expense that you have to capitalize. It's going to be greater than a year. So it wants you to put in here capital expenditure. For the annual tune-up, well, a tune-up's not going to last more than a year. So that's why we say, hey, that's a revenue expenditure. Pay $264 for the monthly cost of replacement filters. It's telling you monthly, they got to replace them every month. So that's not a long-term asset. So it's a revenue expenditure. Complete in addition to a building. Well, that's going to last longer than years. So you got to capitalize it. Now, what does it want over here? Prepare the journal entries to record transactions A and D. So right over here is 66,000. So let's see if it gives us anything here. To motor on equipment. So we're paying cash of 66. And what about this equipment? What do we do here? Accumulated depreciation, building. So it's going to extend it, right? So let's see what happens. Okay. I thought I was looking for equipment, but I couldn't see anything. There it is. Okay. Because it extends it, the equipment has additional value. And if you want to return, then you got to do number 2. Okay, we did that one. We did this. Okay. And then here again, for cash of 325, and it's going to be the building. You've added to the building, right? All right. Everybody all right? Because they're lasting longer than a year. Okay. All right. Okay, hang in there. Natural resources. Pettis Company acquires an ore mine. It costs $2,940,000. It incurs additional cost of $823,000. So the cost is this plus this. So add those two together. So our real cost down here is $3,763,300. Now, what's the salvage? It holds 2 million tons of ore, 200 mined and sold the first year. After the ore is removed, they think they can get 420,000 for the land. Amount subject to depletion. So you subtract that. Now, what's the capacity? The capacity is 2,000,001. So the depletion, you take this, what you paid, minus how many tons you estimate. Remember, we don't know for sure. It's an estimate, so we think it's going to be $1. I'm going to go with $1.60. $592. How much did we sell extract the first year? 235,000. So our depreciation is, or depletion, I'm sorry. Units extracted. Okay, I'm sorry, I got the wrong number there. 235 and 374.31. All right, let's see how it likes that. Our math right? Okay, so did I make a mistake here in my calculation? Let's go add it together. 2,940 plus 823,200 is 3,763,200. Oh wow, off by $100. 3,763,200 minus 420 is 3,343,200. And then that divided by the is $1.59.2. So that ended up being the same. Let's check now. $1.59.2. So let me take that. 2,000,001. 1.592 times 235,000 tons is 374,120. So this 374,120, now I have our journal entry. And what is it? It's depletion. It's not depreciation. It's not depreciation. It's called depletion. Okay, depletion expense. You're depleting the resources, and it's accumulated depletion. Okay, and for that number, and it's based on how many tons of ore you pulled out of there. Well, what did it look like? 374,120. I thought that was our number. 374,120. Prepare the entry to record the cost of the ore mine. No, I'm sorry. This is the year in adjusted entry. So when they buy it, so what it really wants, it wants here the first one. So here it's cash. How much cash did you pay for the ore mine? So this is cash, and up here they want how much did you pay for the ore mine, and then that was the 2,000,094 plus that 3,763,200. 3,763,200. 3,763,200, and then The B is recorded for the depletion expense. Now we put the depletion expense accumulated. And I think it was 374, 120, 374, 120. All right, how about now? Okay, very good. Finally got it right. All right. Okay, let's go on to 14. They pay money to modernize the store. Improvements include new floors, ceilings, wiring, and the wall covering. The improvements to yield benefit for 8 years, but the lease is only 5. So are you going to recover it over 8 years or 5? Well, the estimate is benefit for 8 years, but the lease, they don't own it, so it's 5. So you divide by the which one? 5 or the 8? Well, so first they want you to modernize the store. So leasehold improvements. So how much you pay leasehold improvements? And we paid cash. Okay, so you improve this lease. You know, you buy this blank part of the building and you got to fix it up. So 150 divided by 8 or 5? 5,000, because you're not going to be there. You might not be there past. So you have to use the terms of the lease. So amortization expense and I don't think, check here. Yeah, I didn't think you used accumulated amortization. To me, it's you just put the building. Leasehold improvements. There we go. Well, I'm not sure what to put then. Let's see. 3,000. It's not accumulated. You don't accumulate amortization. It's an impairment, land improvements, leasehold improvements. Not sure. Let's see. They are leasehold improvements. You are dealing, but it says you don't accumulate them, huh? I didn't think you used that. Huh. You do. All right, very good. All right, last one. Disposal of assets. Record the disposal of machine receiving nothing in return. The machine is extensive, was not worth. They disposed of the machine receiving nothing. They cost 125 and has accumulated appreciated 96. So think about this. This has a debit balance and you're getting rid of it. So if you want to get it off your books, what you would do to it. And if this has a credit balance, what would you do to get rid of that? You debit it. And how do you get rid of the machinery? You credit it. So this gets rid of the machine. This gets rid of the machine. And this is the accumulated depreciation account machine. So by debiting it, you close it. By crediting it, you close that. Well, what's the difference? You got to have, what do you need? A debit or credit? You need a debit of 64.5. And you paid 125 and you only recovered 90,000. So what do you think this 2034 is? It's a loss on the disposal. You made a loss, okay? You lost money on disposing of that. All right. So now on the next one, you sold the machine for 16. So machine sold is cash. You need a cash entry here of 16, but you're still going to be short because you need to sell, you need to go whenever you have the book value. So what is the book value? Let's make sure you all understand it. You paid 125, you've recovered 90,600. So the book value is 34.5. It's still on your books for 34.5. So the truth is, if you get less than 34.5, you have a loss. If you get 34.5 like in 3, you just broke even. And if you sold the machine for 47, you have a gain. So anything less than 34.5, you have a loss. Anything more than 34.5. So the book value tells you what it's on the books for. All right, so y'all should be able to solve that. Remember, and then the next ones will be cash. You just have to add cash here and then loss or gain or no even. Now, I would like to share with you just a few things here. Years ago, and y'all are probably too young, but the Muppets. Do y'all know who the Muppets are? You've seen that movie? Some people like them a lot. Well, when y'all, around the time y'all were born, 3 years after selling Jim Henson Company its Muppets to a German media company for 680 million, the company bought them back for 90. They were a big flop in Europe. These people lost like 400, 500, 600 million in Europe, and they bought them back. And then Disney bought them. So in other words, that those assets are not worth those those cartoon figures are not worth 600 million. So that is what's called goodwill. They're worth more than the assets are worth. So if you paid $20,000 for a car that's only worth 10, the difference of that 10 is a goodwill, paying more from the assets. The goodwill for the cartoon characters, cigarette characters, Marlboro Man and Camel are like in the billions. So that's what goodwill. Now, to help people, everybody was having to go to Washington to get their patents and trademark office. So Texas, Dallas opened one in 15. So just now, after all these years, in the last year, the U.S. Patent and Trademark Office opened up. First one in Detroit, Michigan in 12, and Denver in 14, and then San Jose, and then now Dallas. So just try to spur entrepreneurship and to help people. The office will provide outreach service for inventors and entrepreneurs in Alabama, Arkansas, Louisiana. So if you're an entrepreneur, consider that now you have an trademark office right here in Dallas. Now, in just the last few days, the Supreme Court has made a giant ruling about a copyright. Copyright is what you're protected for. Like any of y'all artists, musicians, poets, well, that's original work. Now, you know what's interesting is I don't know who created emojis. I don't think emojis are protected under copyright, to my knowledge. So whoever created them, I guess they just wanted them to be used by everybody. There's no copyright, so everybody can use them. Well, anyway, the copyright case of the century for a decade, software Oracle has accused Google of stealing code from Java programming. But Google argued it was fair use and therefore protected by law. Java is a common programming tool, and many said Oracle's claim would be like telling an architect you can't use bricks. On Monday, the Supreme Court agreed. This is like the copyright case of the century. The decision has implications beyond the tech world. So back in the late 80s, the rap group 2 Live Crew did a song sampling Roy Orbison's Oh Pretty Woman. 2 Live Crew argued that some of the lines were used to make a new song. In 94, the Supreme Court agreed, calling it transformative use. Transformative. Ever since, some courts have expanded the definition of transformative use, which has made some in Hollywood nervous. So anyway, this is a giant thing. Creative uses of existing creative content. So anyway, we're not sure. You're going to have people arguing both ways. But this is a giant case just decided this week about Oracle and Google. Now, patents. These are patents that were lost last year. Now, when they issue a patent, they're issued a patent for like 20 years, but each new drug is guaranteed 5 years of patent exclusivity. So you got after 5 years, if they haven't recovered their money, they lose money because it costs billions. Right here. Evaluate Pharma estimated in 16 there could be up to 200 billion losses due to patent expirations between 15 and 20. In 18, it predicted up to 30 billion. Market realists know that 12 blockbuster drugs will lose their patents by 2020, leading to a loss of 67 billion in annual revenue. So who lost their patent last year? Nautilus Rep, Noxafil, Acepa, Chantix, Juxtapid, Absarbica, Saferis. All right. I hope I pronounced all this right. But anyway, patents are issued for 5 years to protect these drug companies so they can recover the cost. It costs a lot of money to invent a new drug and things. Now, here's what I thought too, y'all like interesting. The copyright to The Great Gatsby, the 1925 novel, will expire 2 years from today. Expires 2 years from when this was published on 2021. So maybe it expired. Maybe it's expired now in 21. The works published in 1920 were in public domain, with 1923 scheduled to expire at the beginning of 99. But then Congress passed the Sony Bono copyright extension, added 20 years, keeping 1923 works until new 2019. So the next January, George Gershwin's Rhapsody in Blue will fall into public domain. It will be followed by The Great Gatsby in January 21. Yeah, so this just expired 2 months ago. And Ernest Hemingway's The Salt Also Rise expanding January next year. Now, here's what. On January 21st, 2024, we'll see the expiration of the copyright for Steamboat Willie, and with it, Disney's claim to the film stars Mickey Mouse. The copyright to Superman, Batman, Disney, Snow White, and early Looney Tunes will fall in public domain between 2031 and 2035. But Mickey Mouse, amazing, 24, will raise tricky new legal questions. All right, so y'all have a wonderful day, and I hope this helped y'all.